Welcome back. We've got a firmer tone once again. Futures are up this morning, indicating a gain at the start of trading ahead of a big day of earnings and economic data. We are looking ahead to Tesla earnings after the bell today. The Dow Industrials right now up 81. Tesla shares are up 1.25%. Yesterday, Netflix beat expectations on earnings and revenue, adding 2.4 million subscribers after losing subscribers in the quarter before. Joining us right now to talk more about that is Netflix stock surges 13%. Potomac Wealth Advisors founder and president Mark Avallone. Mark, great to see you. Thanks very much for being here.
Good morning.
Interesting to see Netflix adding subscribers. Is that a telltale sign? You know, I was thinking that when you're stressed financially, one of the things that you give up first are maybe your streaming services, but we didn't see that this quarter for Netflix.
Well, Americans have a near addiction to spending. We enjoy any liquidity we have. We have low savings rates. People like to consume. And staying at home is actually not an expensive way to enjoy entertainment, certainly not relative to going to the movies and spending $6 for a box of popcorn. So I'm not surprised that if the economy slows down and if there's consumer cash available, that they spend it on something like Netflix. Plus, the product that Netflix is offering is becoming more competitive. Winter's coming. People are going to stay home. So this was not a surprise that they had a strong report.
Yeah, but we've already seen some really deterioration, demand destruction. Look at the housing market. And this morning we'll get the mortgage applications out. We'll get that in the next hour. We get September's building permits and housing starts at 8:30. Home builder sentiment tumbling to the lowest level since May 2020. Yesterday, Mark, as mortgage rates now hover around 7%. What does that mean for housing? And do you think these higher rates are going to create demand destruction elsewhere?
Yes, and this is exactly what the Fed's plan is and why there's a bifurcation between consumer expenditures for airline tickets, which we see up, Netflix, which is strong, and the housing market, which is going into a decline. The Fed controls interest rate sensitive areas. Purchases for homes and autos that rely on the extension of credit, they are going to slow down. It's not just the rate, it's the regulation, it's the approval criteria are going to rise at banks. Banks are going to want to hold on to money more, especially if they can go out and get 4.5% on a 2-year treasury. Why would they risk consumer credit risk? So you're going to see the Fed's plan come into effect and be successful on the backs of people who want to buy that first home.
Mark, hi, James Freeman at the Wall Street Journal. Wondering if you could explain the market right now. Futures up, good day yesterday. We get so many research reports out of Wall Street saying we're doomed to recession. They look at, and we talked about housing, obviously a lot of indicators heading south. What do you think's going on right now? Are the earnings so far maybe not as bad as people thought? How do you explain this recent kind of little mini bout of bullishness here?
Well, a combination of things are happening. You had stocks beaten down so much. You have bank stocks in mid and high single-digit PE multiples, so they were selling cheap. And when their earnings reports came out reasonably strong, you had a reflexive rally, and investors who were underweight stocks and people who were short the market had to rush in because the banks actually delivered. But I think the concern and why bank stocks are remaining in single-digit PE areas is because the risk of credit defaults is always an overhang on banks. So as long as that's out there, there's a specter that we may go into recession, and financials would be one of those areas that get hit. And that is what I think happened this week. I think what's going to be more telling is how the tech earnings come out. Netflix, sort of considered a tech company, but when these tech earnings come out next week, I think that's what's going to give investors the best indication of whether or not taking a risk-on approach has merit.
Yeah, Mark, that's a good point. I mean, tech obviously has gotten hit the hardest here, but you mentioned something I agree with too, is Americans just love to spend money. And I think strategists on Wall Street always forget that, and they always say it's the death of the consumer. And it seems to me, like you just mentioned housing, if housing prices are coming down rapidly, those inflation numbers are going to start to look pretty good. And if wages stay strong, I mean, theoretically in like 12 months, the economy could actually be in pretty good shape. And I don't think anyone's really talking about that right now.
Well, I think when you have this, what we happened with COVID and the specter of death and people being forced to remain inside with masks, you are having a psyche change where going out and enjoying life and spending money and living on your own terms is an underestimated factor that's driving this spending. People are planning trips. They're not slowing down. I'm not hearing people say they're not going to a great restaurant because budgets are tight. People who have money will spend. The challenge is actually on the lower and working class people who the Biden administration claims to help. That's where inflation hurts the most. It's not affecting the wealthy as much who have the discretionary dollar. United Airlines said ticket sales are way up. Their leisure travel's way up. People who have money are spending. This is compressing people in the working class.
Yeah, but how long does that last? I mean, what you're saying certainly was indicative from the CEO comments we got this week. You had Goldman Sachs CEO David Solomon adding to the bank CEO conversation on the state of the economy, saying there is a good chance of a recession, so it's time to be cautious. But Bank of America CEO Brian Moynihan said that the current consumer environment is strong. Then you had JP Morgan CEO Jamie Dimon, of course, doubling down on his, quote, economic hurricane prediction. So very much mixed stories from these three banks. But I think it is speaking to the strength of the consumer. We've got the Fed's beige book out today at 2 p.m. Eastern. Any expectations of a big impact there from the beige book, Mark? Because you have to wonder how long just one portion of the population is impacted by this, especially if people are going into their savings accounts to pay for 40-year high inflation. It catches up, doesn't it?
It does catch up, and I think we're going to start to see the curve bend a bit. I think we're going to see ticks up in unemployment as we hear more layoffs. We heard Microsoft today slowing down hiring. Google has put a freeze on. Meta has slowed down. I think eventually manufacturing and capital-intensive areas will feel the weight of the cost of capital. So I don't expect robust economic growth from here on out. The hope is we have modest recession, not a hard landing.
Mark, it's great to talk with you this morning. Thanks so much.